Good morning, folks. All right, so I'm going to try to get through this rather quickly. Some things have occurred while I was asleep last night that I want to look into concerning the Middle East and Israel and whatnot. The dollar index here on the weekly chart, we hit our objective, the first objective, which was this candle's high on the weekly chart. So that high comes in at 107.274. And the week that we just closed, its high is 107.348. So just above it, reaching into this imbalance. Now, having the retracement like we saw in the lower close, that to me is perfectly acceptable. We've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks of buy-side delivery. And that's like 3 months of steady one-way direction to a premium level, and it's reasonable to anticipate something of a retracement. I'm not trying to pick the top in the dollar, as I mentioned many times before. Incidentally, you might want to take a look at the economic calendar. I'm not going to show it here. It's something that you should be looking to do on your own anyway, day by day, and for the week to come, always on the weekend. Try to get a feel for what it's potentially offering in terms of underlying risk with the high impact news drivers or medium impact news drivers or Fed chair speakers, something to that effect. And there's a lot of that next week. So next week's trading will be laced with a lot of volatility. Monday's a holiday, so we're going to have a pretty wild week to come. And with all the things that just popped off with the violence over in Gaza and Israel, that's going to increase tensions as well. So I know it sounds silly that, those two sides always have an issue with one another. I do believe we're going to see something significant arise from all this. So for the folks that have been watching or listening to the Twitter space that I did over a year ago, I told you about in 18 months from then, we'd start seeing some stuff going on. We're at it now. Okay. So you need to be paying attention to it. It's going to have its reverberations in the marketplace. It's going to have reverberations where you live, even though it might be on the other side of the world. That stuff's going to start happening and impacting your everyday life. So, daily chart, you can see we went right up into that inefficiency, right above the high that we were looking for. Or not the high, but the low of the inefficiency. That's what's being highlighted here. And there was buy side still that I have an interest in. We rallied up. Friday, we went right up into this small little gap in here between this candle's low, this candle's high. Non-farm payroll sent it up and then rejected it. Consequent encroachment of this wick. We'll highlight that. So 105.90 and 4 pipettes. That's a level of watch. See if there's any kind of reaction off of that. Otherwise, we could return back down into this daily gap. Okay, so I'm going to leave these levels here as they are. We're going to drop down into an hourly chart. You can see the effects of non-farm payroll. I did a quiet, not intentionally, live stream the other day, and I talked for like an hour, thinking that the audio was good, and I took the chance of assuming that it was, and like Murphy's Law, whatever can go wrong did. And I've done that in the past with recordings, pre-recorded videos, and some of them were rather long and discovered after the fact that the microphone was on mute or wasn't connected or had an issue and didn't pick up any of the audio. So a little bit of an annoyance, but I drew out key levels for liquidity. I mentioned this one in here, and I mentioned this one here, by graphically depicting it on the chart, even though I wasn't saying audibly. If you're a student of mine, you know exactly what I'm drawing your attention to, the liquidity above and below. And we went right for it again here on non-farm payroll numbers, then rejected it. So they pumped it up during the 8:30, even though it's showing 8 o'clock, it's an hourly candle. So it's including the post NFP number release at 8:30 a.m. and then quickly sent it lower, attacking the sell side here. So here's that consequent quotient of that daily wick, 105.904, and the daily fair value gap there. And I mentioned how when we were up in here, just be mindful of this order block in here and that gap. So ahead of the non-farm payroll, we were working in it, trade down into the order block a little bit more, and then sent it up into buy side, and then rejected and sent it to the sell side here. Going into next week, you want to have this level here, this shaded area. I'm going to look at that as a potential inversion fair value gap going forward. So it could come back up, trade into the breaker, which is high, low, higher high. It took liquidity. This down closed candle, that is your breaker, and it is inside of the lower end and lower quadrant of this old inefficiency. Now, because we went through it, it's reasonable to anticipate lower prices initially going into next week. So if we see it trade up into that, that might be a catalyst to send this lower. If we don't take out this low first, I like the idea of coming back up in, hitting the breaker, touching this in inversion fair value gap, and then trading lower for the sell side. Worst case scenario, we open with a gap lower and never return back into this area here, which is, you know, potential. You never know where we're going to open up on Sunday. Now, because of all the militaristic things that are going on over in the Middle East, those types of things cause a lot of concern, and they like to use those things to stimulate the marketplace. So we might see an extreme gap opening on Sunday as a result of what's taken place last night and what obviously will be going on for the remainder of the weekend going into next week. Let's go into the daily chart once more and breeze on through to Euro. I don't want to spend too much time this morning. So we had the relative equal lows. We mentioned that. We traded down into it. My targets, as I mentioned earlier in the week, I was done. Like everything was met. Everything I outlined was delivered in price for the dollar index, the euro, for the pound dollar, Aussie dollar, ES, and NASDAQ. So everything I mentioned, with the exception of gold. Gold didn't quite get down to that 1804 level yet. So that was the only thing that didn't really deliver thus far. But pound dollar, we saw, euro dollar, we saw it delivered below the sell side and came back up. Watch this gap in here once more, and then the order block right there. So these are the PD arrays I'm watching. It's perfectly acceptable for it to retrace back up to here and still not really have anything in terms of a confirmed reversal. And it's really important that you understand that I try to avoid, what I'm highlighting here is the order block opening in the low. These two consecutive up close candles, that's your bearish order block, which is above this gap, and this short-term high right there on that candle is buy side. So those are the three PD arrays I'm watching. We've already traded back to consequent encroachment of this wick here. So this is kind of like the line in the sand. If we get above that and start to expand or accelerate in terms of speed, then it might be much more deeper retracement required. And in that case, we may have to revisit this. Okay, so if I were to be held to tell me right now what makes you confident that we probably made a an important low for the rest of the year and it goes higher from where we're at, it needs to take out this high. And then once it goes above this inefficiency, should it ever do it this year or the remainder of this year in 2023, we hit it in active support. Once it starts doing that, then and only then would I'd qualify that as a low of any real significance. I tried to teach the avoidance of trying to pick tops and bottoms because it's a skill set that you're not going to be consistent with. No one's going to be that consistent with it. And I'll just leave it at that. Okay, so it's not important that you try to get that type of turning point. You want to trade in a direction of order flow, which removes a lot of the concern for being perfect. All right, so here is the business on the hourly chart on Euro. You can see we traded down, took out the sell side here, and went right down to that old low, nailing it here and here, the old low on the daily chart. That's what we were looking to see it sweep below. That's what that level is, and it hits it beautifully, then runs back above. So there's buy side here, so just be mindful of that. That might be what we probably gap above. You know, I wouldn't be surprised if we end up gapping above or gapping close to this and then running a little bit higher on Sunday. Daily charts, go back up to that time frame and look at the pound dollar. All right, so pound did again what we were looking for. We were looking for lower prices. It's acted much like the NASDAQ in relationship to the ES, whereas pound dollar was a little reluctant to go lower in sympathy with the euro dollar, with the run to our premium target on the dollar index, that daily inefficiency, where we trade to it this week, and then we've been selling off since then. The wick and consequent encroachment of that, you know, we have to watch this. This is going to be going into where we open next week, and we could revisit back into shorter time frame premium arrays. Again, avoiding the entire idea of picking the bottom. Okay, I'm not trying to support the idea of anyone doing it, and I don't try to do that myself. So longer term, I'm still focusing here, and you know, for 3 months straight, dollar index going up, having one weekly down close doesn't change the trend for me. So if it's going to have a retracement, then it's going to be seen, you know, conversely with other forex pairs. So they're going to have a little bit of a, you know, retrace as well, but avoid the whole idea of trying to pick a top and bottom respectively to those markets. Longer term, I'm still focused down here for sell side. And let's take a quick look at Aussie dollar. I was looking for the sell side to be upset on that market, and we showed it the other day, and we got it here. So as long as we stay below these highs here, I think we're lower, you know, across the board for Aussie. I liked how we went back up in this inefficiency. So have this on your chart. If we resume higher on dollar next week, and we don't really move outside of this inefficiency on the upside, we'll be looking for lower prices on Australian dollar down to get into this sell side right there. Okay, that kind of gives you an idea. If we break above these highs, I would not be interested in Aussie dollar at all. So I'd like to see it remain heavy and bearish, and then eventually, you know, reach below here. Otherwise, I would not want to be buying, going long on the Aussie dollar. Just not interested. I'm not trading forex at all anymore, but I know you all like to hear my opinion about it. So that's that. Gold, we'll do that one real quick. All right, and as I mentioned in the live streams, in the recent weeks, I said that gold would be looking to trade down into this inefficiency between this candle's low, this candle's high. That's why this is being shaded here. Once we broke through it, it would act as an inversion fair value gap. We opened on this day, trade up into it, broke lower. The order blocks and the sell side was the relative equal lows. That was where I was taking your attention to. This was the very short-term target we didn't get that on Friday. Non-farm payroll came in and did its thing. And ultimately, I still think that this is a viable target. And let's see where we at. Let's do ES. All right. Okay, so ES, we traded it into our old inefficiency here. Body stayed inside that. We had candlestick tails or wicks, however you want to refer to it. It's the bodies are telling you the narrative. So if we have a deeper retracement, it's perfectly acceptable for it to come back up into this area here. So my eye is on this inefficiency right there. So it can trade up into that inefficiency, and it's still, by my definition, hasn't reversed, and it would be completely acceptable. So I could trade up here and then end up trading lower. These lows here, just a little too clean for my liking, and over here. So sell side in here, and this low is my focus. Longer term, I'm completely willing to be proven wrong, because on a daily chart, these ideas tend to pan out over a longer period of time. It's a lot more forgiving as well in terms of a missed move, or if you do something wrong with the analysis, you can get yourself back in sync and then trade once you get better visibility of what the market's likely to do. Right now, I'm still holding and subscribing to the idea that nothing has changed to bullish. There's absolutely zero reasons for anyone to be bullish on stocks. I mean, there's nothing. There's literally nothing for anyone to be at these multiples. If you're going to talk about things fundamentally, it's absurd where these stocks are still trading at. It's ridiculous. And at some point, the chickens are going to come home to roost, and that means things are going to have to hit reality, and lower prices are in order. So try to avoid all this business in here. I don't think we're done, and lower prices is where I'm focusing. But this short-term likelihood of a retracement, it's completely within the realm of possibility. 60-minute chart. All right, and here is sell side. Non-farm payroll, drop down into that. Hit the order block here. Rallied up. Obvious buy side waiting right here with an inefficiency over here. So you want to have this on your chart going forward into next week. And again, with everything that's going on, geopolitically speaking, we could really see an extreme gap opening on Sunday. So, and it could be either direction. So I'm expecting a lot of difference between where we settle on Friday and where we open, because it could do either one. I tend to think that this was all pumped up ahead of all the economic news drivers that are due out, and all the speeches that's going to be had on the trading week that's coming. So just be mindful that this is classically what's seen with non-farm payroll, in my opinion. They take the market in a direction which many times is like a fake out. Okay, just like I teach that the non-farm payroll and the rate announcements for FOMC, they are two-stage deliveries, whereas initially we see the market drop at non-farm payroll. So that's the first stage. And then the second stage is the reversal of that move. And then you see it happening here. Every single time we sit down and do FOMC analysis, or if I've done them live streaming, watching it happen with you over shoulder, It's always the case where it's two-stage delivery, and it was just like this again on Friday. The only thing it was a little bit surprising is that they took a whole lot of distance in like 2 minutes. Very, very short time. They covered 175 handles, and that's a wonderful illustration of why you need to be respecting the measure of risk with this particular day, because it can harm you and your stop loss won't work. Like, it won't work. In the first minute, it gapped down 80 handles on NASDAQ. So, that's a pretty significant drop, and no one can really tolerate that if they're doing 15 contracts. That's a big smack in the face. Keep my wife's name out of your mouth. So the buy side here, they ran on it aggressively, and I talked about how the market would likely close in its upper 50%, upper 60% of its range, and we got that. So it's all in the live stream, and I'm not trying to save face here, because everything I said in the live stream, you're welcome to go and listen to it for the Non-Farm Payroll live stream, where I was watching it live with you. The things that would be concerning, things that would be utilized for reading price, all that stuff is in that live stream, so you can listen to it and revisit whatever you want to take away from it. The drop, again, at 8:30, that was the first stage delivery. It means it's the fake drop, it's the fake move, it's the thing that's most likely going to be faded in the rest of the day. We see that happening here, 8:30. Look at the high up here, upper left-hand corner. That comes in at 42.94 even, and the low comes in at 42.48 and a quarter. That's a significant amount of handles for S&P at $50 per point or handle. It doesn't take long to go into significant drawdown. Swing high here. Let me take that off here. Swing high taken here. So there's a shift in market structure. That low to that high, as it's retracing, what's it reaching for? Inefficiency right here. And order block, the last down close candle. Note the bodies, where they reside inside that fair value gap. See that? I'll zoom in a little bit so you can see it better. So even though we went outside, that's a mohawk. It's just a little tiny coloring outside the lines. It's typical. And then we rally up, order block, touched, body, both on these candles, signifying that, okay, we're probably going to run higher. So where's it going to run? Rebalance all of this and go back to the previous day's settlement. So using what I teach in terms of the regular trading hours, where we settled the previous day here on Thursday, it trades right back up into it there. Okay. And you need not see it trade above here or here to be profitable. All right, let's go into a 1 minute chart. And we'll take a look at the silver bullet. Okay, the fair value gap, we drop down into it. We don't get a shift in market structure until, this is, technically it's a shift in market structure above this high right there. And they used the higher time frame 5 minute fair value gap, which really could have been refined to inside here. So dropping down lower time frames on a 1 minute chart, you would have that. That would be a little bit concerning for me there. So again, it would have to show a willingness to want to go higher. And it does that with this swing high being broken there. And the underlying premise would be this was the first stage of delivery, and the second stage would be moving back up. And I mentioned in the live stream that it might not go above and go higher. It could just go up here, rebalance, and then consolidate because it's Friday. It is on the heels of non-farm payroll. We've covered a lot of distance, and we had already had a intra-week retracement from dollar targets, ES targets. So one of those things were likely to be a catalyst to cause us to be content with consolidating, but they've taken a great deal higher, which to me, looking at it now, it feels like it's all fluff. They're fluffing it up going into next week, and then next week major damage is going to be done. And I could be wrong. They could be sending it even higher, aggressively higher, and it's okay. As long as it's moving around, I don't care. I'll find something. I'll get in there and do something. But we want to try to have a good read on it using the daily charts. And it makes things a lot better when it is in concert with what we have expected or expect with the weekly chart. So that's what I'm saying. Ahead of the new week, where I don't know where we're going to open, but I think we're going to have a big gap opening, one extreme or the other, above or below on all the markets. But I think we'll have a very volatile week. And I'd like to see, initially, I'd like to see it retrace a little bit further lower on dollar to kind of like sell the idea that it topped to retail traders, and everybody else go long still at these elevated levels on ES, NASDAQ, Forex pairs, and then in gold. And then they send it lower aggressively next week. By next Friday's close, I would like to see lower levels on all the Forex pairs and on ES and NASDAQ and gold, and higher prices on dollar index. That's what I'd like to see. But I have to have the alignment with the technicals and what price is doing when it's time to expect it to be delivering. So this is a matter of waiting and seeing. So going into next week, that's what I'm expecting. But we see it trade back down into that inefficiency here, and then it starts to really ramp up, and that occurs at 10:21. Okay, so what you don't understand is this is a silver bullet because it's using a fair value gap, even though the fair value gap is outside and before 10 o'clock. And this is part of the rules. So go back and listen to the recording. The fair value gap does not need to be inside of 10 to 11. The setup is a retracement into a fair value gap between 10 and 11. So seeing that is the case, and we're seeing it rally up. If you didn't take this one in here, you could use this one. And it found its opportunity to drop down into consequent encouragement, which is midpoint of that gap here, with the expectation that we would see it at least run back to the previous day's settlement by using regular trading hours, which right now we're toggled at electronic trading hours. So from here to where regular trading hours, previous settlement price offered room to rally, which would be going above this high and maybe reaching above here if you're so inclined to hold that. But silver bullet, we're only looking for 5 handles and as a minimum, and it offered it here. So it ended up keeping you held on to it. That's a pretty good run. And settling on the close. And here's your silver bullet at the 2 o'clock hour here. That fair value gap. All right, so let's go up to the daily chart and do NASDAQ and be done with this. All right, there's a whole lot of business going on in this one, isn't it? All right, so I wanted to see it trade down into this inefficiency. We have returned back into this area right up in here, so I'm going to add this for the sake of this analysis. Okay, so we traded up into that inefficiency there. We are avoiding trying to pick the bottoms. Okay. Again, I feel like this was all part of this consolidation. Trailed stop losses were brought down to here, and also getting up into this inefficiency. Perfect excuse for them to have run liquidity or anyone that's been trailing it, because I believe that we might be seeing a larger sell-off coming. Okay. And this would be classic scenario for that very thing. So we've consolidated. Everyone wanted to see it drop lower. I wanted to see it drop lower, but it just wouldn't drop. Doesn't mean we couldn't find setups. Obviously, we've outlined it. You saw me executing. You saw me doing things with it. And long story short, where we're at, by taking the buy side above these highs here and back into this inefficiency, this upsets anyone that has been short. So now, if we are going to see a lower delivery and price on the indices, specifically NASDAQ, I'd like to see it be trading down here. That would be perfect engineering of sending it higher, getting everybody thinking that we're bullish when we're not. I'm not bullish on NASDAQ. I'm bearish. It doesn't mean that I won't take longs. Okay, it just means that they have to be intraday scalps, because it's going against my higher time frame order flow and bias. And the narrative, I think, is that we went higher to upset the shorts, knock them out. And if they're buy stops that are being trailed while they're bearish, if their buy stops being triggered above this high, those buy stops are being accumulated as smart money for shorts. Like that's the internal dialogue that I'm holding when I see this chart as it is. So I know there's a whole lot of this stuff here because I don't have it set to only show on specific time frames. And I just wanted to go out here and do this because I want to spend a lot of time studying what's going on over in the Middle East, because I want to talk about it on Sunday on a Twitter space maybe. But the idea I'm holding here is we went up just to go down. That's kind of like what I'm suggesting here, until I'm proven wrong. And what would make that a truth? This inefficiency, if we trade above it and it touches it and starts to show some support and starts to rally, then I'll concede and say I'm wrong, and maybe something underlying did occur down here that I missed, and then we're going to go higher. There's a whole lot of things in motion right now, and geopolitically with Russia and China, there's so many things that makes it very complex to have a macro read from a weekly and daily that has a long-term time horizon that won't be met with short-term disruptions that may challenge the opinion or sentiment idea of someone that's been doing a lot less. So I'm leaning on the fact that I know that this is the climate for that to occur, meaning I see in the chart that it's not enough for me to trust that it's made a low. Like, in other words, I don't see it from where we are right now. I don't see it trading to make a new high up here. Okay. I don't see it as bullish. I just see it as going up to get ready to have another a sharper drop lower. Okay. And if I'm wrong, it's fine. It's okay. I mean, it's good for you to see me get it wrong. It doesn't happen all that often. It sounds arrogant, I know, but it's the truth. So anyway, the hourly chart, we had buy side in here. We finally got that level tagged, but not before seeing the drop below here, taking out sell side and rally up. This opening range gap, that level, I taught how to determine what that is. And it's, again, using the regular trading hours here. So that was Thursday where we settled. And then on Friday where we opened at 9:30, we had an opening gap. So it makes it the opening gap high. Why? Because we opened down below it. Remember, we start this annotation with opening range gap settlement. So as soon as we get to around 9:15 or so, right before, several minutes before the opening bell at 9:30 Eastern time. That'll tell you what it's likely to do. And since we had a gap opening lower, we went down, took out the previous day's low, wicked through it, and then came back. That trade here, that was the premise I was working with. Okay, so for I'll get to it in a second. Relative equal highs, there's buy side there, and then there's this actual gap, which is a real liquidity void. Okay, when you see these single candles like that, okay, technically that is not a liquidity void. A liquidity void is where there's absolutely zero trading going on between two candlesticks or two time frames. So this duration of time measurement on that candle on the hourly basis, and then the next candle here, there is no trading at all between these two price points. This candle's low and that candle's high. So this is a real liquidity void, and the price gets itself worked into buy side delivery here. So my question to you is this: if this was a real gap, and it is obviously, if it trades up into it here with buy side, what would make it a balanced price range? Sell side. So I'm expecting price to want to pass that back down into this range, because every gap should be, or every inefficiency and or gap should be delivered with both up and down price action. So a buy side delivery as market goes up through one range defined as we have here, the difference between this candle's high and that candle's low, there's no trading there. No one had a trade there. No one had a fill. No one was selling short or buying long. No one was closing trades there. There was literally nothing being booked between these two candles. That's what makes this a liquidity void. It's void of liquidity. So what will happen is the market algorithm will deliver price to and through that range. And what has it done so far? On the hourly chart, it's only delivered with buy side delivery. Not liquidity, buy side delivery. That means price has booked delivering price as it goes up. So it's reasonable to expect it to drop back down for the sake of offering both buy side and sell side. And then once that occurs, then the real narrative will be in play. Do we go higher or do we go lower? And when we leave that range that's shaded here, it will act as a balanced price range. In whatever direction it works from after the balanced price range is established, that's probably going to be the price run that has a lot more sustainability versus right now I'm speculating and not really having a clue what it wants to do exactly going into the opening on Sunday. Like, we don't know what it's going to do. No one knows what it's going to do, but I do expect an extreme gap opening because of all the things that's going on right now. All right, 15-minute time frame. Okay, so here is our gap here. And again, showing regular trading hours. This was Thursday's settlement. And then where we opened down here, so that opening range gap is from here and the opening of that candle. Then we had this inefficiency here. And then the new week opening gap and its consequent encroachment in that buy side that we were talking about all this week. Finally got its rear end smoked and then powered through it. So again, here's that inefficiency that I mentioned that is a real liquidity void that buy side was delivered to. Look at the reaction here. That trading rate there, reaction there, is that low of the liquidity void on the hourly chart. So you have to have these understood. Visually, it's probably going to be helpful to you if you have them drawn on your chart. If I was awake and I was sleeping during this time, I was trying to take a nap, but I ended up sleeping over 5 hours. So I was apparently in need of rest. But I wasn't able to see any of this stuff here in the afternoon. So it would have been something I would have liked to take a trade on. I would have done this here. Like as this candle opened and dropped down into the order block there, I would have used that to go long, trusting that these lows here wouldn't be touched again because it's the low of the liquidity void on the hourly chart, which is a range that's defined where there's absolutely zero trading, just like there is no trading here. See that? So a good example of what I'm talking about where there's a liquidity void, there's one right here. Okay, look at it here. From that candle's low, I'm sorry, that candle's high and that candle's low, we'll extend it out in time. So what's missing in here? Buy side and sell side, delivery. So there's no up or closed candlesticks or wicks until we get down here. So we see it trade down into it here. We see it trade down into it here. Look where the bodies are stopping. You see that? That's not random. Move down again. The bodies are staying where? Inside of that real liquidity void. Chris Laurie's not going to teach it like that. Okay? And I know that sounds disrespectful, but I'm so fucking tired of hearing people say that I regurgitate or teach what he's taught, because I had the man himself come out on Twitter and tell you all publicly, it ain't it. This, when we leave it, okay, we've taken out the sell side here. We traded back down into an inefficiency that's a larger time frame. Then we leave it. This energetic runaway makes this a balanced price range. This gap here, what is it missing? Buy side. Not any longer. It's been offered there. So in this area here, between this candle's low and this candle's high, it's missing what? Sell side delivery. That means down delivery. Price moving lower. So in my mind, here's how I'm visually thinking about this as I'm talking about it live with you. Well, live in this recording, right? It's 8 o'clock in the morning on Saturday. So that's as live as it's going to get. So the market is being pumped up ahead of next week's economic calendar. And I believe, because we have a short week, because Monday's a holiday, I believe that we will see acceleration in terms of volatility. And I believe that all of this is fluff. And this area down here will be needed to be revisited. So I'll highlight that now. So it's on my chart. And everything else I'll remove that's not salient. Like, for instance, this opening range gap high. I don't need that anymore. Actually, I'm going to keep it on there for a moment. The 5-minute chart in here, you can see how we trade down into that inefficiency after taking sell side on the Thursday low in the morning session. We rallied up. 11 o'clock, we have a fair value gap with a breaker. So we have this high, low, high, lower low. And I apologize. It's a lot of lipstick on this. I apologize. But I want to get through it. And usually I would have all these things removed so that way I can take your focus right to the only thing I want you to be looking at as I'm talking. And that's why I do it with PowerPoint. It makes it a lot easier. It makes it like very streamlined for me to teach. But whenever I'm going over charts live like this, and I'm pulling out what I see as it's happening, it's a little bit more organic. You know, some of you like it like that. But for the folks that tend to complain that I go on and on and on, because I love teaching and I want you to know everything about what it is I'm talking about, not just be familiar with it and give you a false sense of security, like you understand how to do it because you watch me discuss something in an abbreviated tense. That's not really learning, and that's not someone that's willing to put in what's required as at work. But the breaker here, and I know some of you are like, well, why are you highlighting the down close candle, ICT? Why aren't you doing the up close candle? Because we're looking at a 5-minute chart. So inside that highest up close candle, the highest candle in a 5-minute chart, there's going to be an up close candle in that on a 1-minute chart. Just give me a moment, okay? Yeah, I already know what you're thinking. I already know the questions you got popping up in your head. But you can see how we worked in that fair value gap right there. There. So institutional order flow entry drill here and here, and then we send price higher. It's also occurring at what price level? What's going on in here? We have the new week opening gap low, consequent encroachment of the new week opening gap, and then the new week opening gap high. So between the new week opening gap low and its consequent encouragement or midpoint level, what level is that between these two? Halfway. It's the lower quadrant, and that's what you're seeing there. So when you have a bias, when you have a narrative in play that you think that the market will deliver, either on a buy side run or sell side run, and you're inside of an inefficiency, you need to be cognizant of the grading of that range or inefficiency is not quarters theory. We're using logic based on inefficiencies and or a range that is implied. It may not be there technically yet. And that's what I talk about in my core content lessons, grading a price range. That is not quarters theory. Even though I'm talking about a quadrant of a specific range, go study quarters theory. And it'll be just like I've told you with everything else. It's not Wyckoff. It's not supply and demand. It's not Elliott wave. It's not none of that stuff. This is absolutely the market. This is what the algorithm is doing. Everything else is going to explain things perfectly in hindsight. I'm telling you what to do and look for before it happens. I'm doing it on all time frames, in live streams, in pre-recorded analysis, and you watch it pan out. That's bending time and space. So anyway, I'm getting ready to go into Twitter mode and start going off, but let me just reel myself in here. Lord help me. So the market rallies up. We have an inefficiency here, and we trade to that as well. And just a real nice run price higher up into the inefficiency that it has tagged, as I mentioned, we went on the higher time frame. So here is the business for the quote-unquote ICT student on Twitter that said I got it wrong. I want you to pay attention now, okay? Pay attention. Because I said in the live stream for the non-farm payroll, it's a two-stage delivery, okay? So it's a two-stage delivery, meaning that it will likely do what? Feed the first move, just like FOMC. I teach you when the rate announcement comes out. The 2 o'clock run to 2:30, that's the fake move. So you have to determine what did they do between 2 o'clock and 2:30 during the rate announcements. Non-farm payroll is the same macro. It's the same thing that they're doing. The first run, not all the time, predominantly yes, but most cases, the first run at 8:30 when the news is hitting the wires, whatever that direction is in price, that is the fake move. That's the first stage delivery. The second stage is the opposite of whatever that is, meaning we saw price do what? It drops down, gets everybody thinking, okay, it's going to go lower. It crushes everyone that's already long. And it did so in stunning fashion very quickly, which scares everyone in the marketplace. It terrifies them. Then the market does the second stage, which is opposing what the 8:30 news sentiment shift caused everybody to think that it would keep going lower, keep going lower, keep going lower. They trap them short, and then they run against the move that took place in the morning. So pay attention. You see that right there? Here, see, let me show it to you again. Here, look at that. You see that right there? That's not market replay. That's not market replay. That is not market replay, folks. Okay? So what that is me trading using the logic of the first stage delivery down here. Let me go into electronic trading hours. Okay? And I'm looking at price, anticipating that it's going to use these wicks in here. Okay, I want to know that I'm on side before I do this, because non-farm payroll can trick me. Sometimes it just will behave in a manner where I will get smoked. If I allow them to do it to me, it's me to blame, right? So because I outlined, the second stage is opposite to what you see in the morning at 8:30 on these big news drivers. I felt that it was something that would be reasonable for it to trade up to the opening range gap high. That's that level right here. Okay. And again, let me take you back to regular trading hours and see where it's anchored. Here is the Thursday settlement price. So that's the gap from where we opened on Friday down here at 9:30. So that gap, I was looking for that gap closure. I'll have to put this back in a second. I was looking for the price to run here. And obviously, as I mentioned, I was tired. So I put the order on, put the limit order on to stop. And if it would have been stopped out, I would have showed you, here you go. Here's what happened. But here is what happened. The price ran up to closing that gap. But more specifically, I wanted to see it trade and give me a limit exit just below that opening range gap high. So that's why you see my exit is 14,856 and a quarter, whereas that price level, let me put everything back like it was because I want that level to stay there because this void is significant to me, and it also has the added benefit of having an old fair value gap in it here. So what is it still lacking here? Big paradigm shift for you folks before I finish this. So buy side imbalance, sell side inefficiency here, and we have it here again. What's it missing? Sell side delivery. We didn't get it here because it's a void and it only passed through one way here. So what is it missing? Downside delivery. So my attention is in this shaded area, in this fair value gap. I'm aiming for that next week. For some trade setup, I'll be looking for that. Okay, I'm going to be looking for that very thing next week. Unless I'm proven wrong, and I'm okay with being wrong. It's okay. It doesn't mean anything. This means that I don't get what I want. And it's okay. It's not Burger King when you're trading, just like mentorships. You can't have it your way all the time. So inside of here, inside these wicks, if you measure like that, you see you have 14,770 and 3/4. So you have that right there. And then you have this order block forming with that down movement right there. As it's happening, I'm also looking at this wick. Right here. 83 and 3/4. So in my mind, as long as I'm buying below that price of that wick, why this one? Because it's slightly higher than that one. But there's two of them. So I want to get a range between both the consequent encroachment of both of them. And that in itself is a PD array too. Oh no, it's going to end up on Amazon in a book somewhere else. Somebody else is going to write about it. You're going to talk about it wrong. That's all the details I'm going to give you here. You love that? Twist the knife, ICT, twist it. Oh, so slow, ever so slow. I'm being mean, I know. But you guys are trying to be ahead of me. And every time I teach something, you want to put it out in a book so you can claim you had it in print first. Technically, it's not in print first. When you do there, you're copying me because I've already put it in production here. Okay, I'm already ahead of all of you. But anyway, a lot of these things that I'm talking about here will be amplified in book format. But you have to see examples of it, and that's what I'm showing you here. So the entry here was 14,775 even, which is between both of those two consequent encroachments of those wicks right in here. The damage is done down here, and as long as I'm buying inside this order block as it's forming, what's the high of that candle? 91.5. What's the low? 63 even. What's my fill? 75 even. It's less than the 83 of that wick here. And above the consequent encroachment of that wick. This is too complicated. Okay, it's not for you. Listen, not everybody needs to be a PhD rocket scientist using technical science. I understand that. Okay, for some of you, this is going to be above your pay grade. That's okay. But you won't get the level of entries that I have in my repertoire if you choose not to do it. You don't need them. You don't need all this stuff, okay? I am sick with it. Okay, it's an illness because I need to know everything everyone else doesn't know. I need to know every little intricate piece of what makes these markets move around. And where I've placed my fingerprint, I'm telling you, this is what's codified. And you're hearing the man that did it. So the run up into that opening range gap high, that price is 14,857 and 3/4. I want to get out as it's going there. And because I'm not going to be there a week and conscious, I want to make sure it's very, very likely that it's going to fill me. So the limit order is just below where I think it's going to reach to. Because what could have happened was it could have went right up to that previous settlement price here and just hit it with the spread not offering my exit. I showed you this year with a live account where I had a limit order and it didn't fill me. I had a large portion of the trade already booked in profit and its stop was rolled into a position. When it turned back against me, it stopped me out in profit. But it did not let me out at the target I wanted because of the spread, which was one tick. So because I was tired, I was fatigued, I wanted to sleep, the limit order on this trade was placed significantly lower than, and you might not think that's significant, seeing it at 57.25 here, and I'm trying to get out at 56.25. So it's, to me, it's 1.5 handles. That's fair. I'm okay with that. I don't have to have the exact opening range gap high price. I don't need that or higher. Now, looking at it, it would have been nice to wake up and still have it, without that limit order there, and just have my stop loss at a level where if it stopped me out, I made $500 or $1,000, something like that. It's a reasonable position size. It wasn't the largest portion of what I'm looking for generally. I wasn't trying to build any kind of pyramiding because, either I'm going to be right or I'm going to be wrong. And using the logic I've been teaching, using the logic I talked about in that live stream, okay, this is a real execution. And you can't hide it. You can't explain it away because it's really there. It's not in market replay. I'll let you see over here. There was no other executions. It's just that one. See? So, this weekend, I want you to rest. I want you to keep your eye on what's going on over in the Middle East because that will have shockwaves that go around the world. And the markets will show you that in price next week, in addition to what we already have as news drivers and volatility injections with all the red folder events that's part of and laced through next week's trading. So until I talk to you next time, be safe.